Today we'll discuss about the modes of mutual funds investing. You might have heard the terms like lump sum, SEP, and then some other terms like step up, step down, etc. So we'll discuss those in detail, and I'll tell you my opinion that how best you can obtain and utilize the opportunities offered by stock market every now and then. So let's go ahead. Here is the agenda. I'll explain about what is lump sum investing, then I'll talk about what is SIP investing, then I'll compare the two, then I'll introduce the words best mutual fund manager, what he has said in his talks and interviews, and using which you as an investor can utilize the opportunities offered by the markets. And then, as happens in all the videos, at the end, I offer my suggestions and takeaways from the videos for you as investors. So here is something about lump sum investing. As the name suggests, it's a single contribution, one shot. Say you want to invest 100 rupees in stock market by mutual funds. You invest 100 rupees, buy some schemes from one or more AMCs, one or more schemes. Immediate deployment is there, that as soon as you give 100 rupees, it reaches AMCs, immediately it gets deployed and you are allocated the NAVs or units of mutual funds. There will be lower admin requirements from the point of view of investors, like you don't have to maintain a minimum balance. One, you have paid the money, it has reached the AMC, units have been allocated, no need to worry about that. Now what happens, no further payments are to be made to anyone. uh, but as a single shot contribution is to be there, and no further payments are required, you as investor or your distributor or your investment advisor has to take care of the market timings and context. What I meant by market timing is, because you're not gonna investing for long in terms of periodic payments, uh, whether market timing is appropriate for you to invest lump sum or not, and depending on your context and the schemes you're selecting are appropriate for your context or not. And sometimes it depends on the context as well. Like I am facing a situation where one of my clients is invested big time in many of the schemes offered by various AMCs from his previous investment advisor. Now his money has already been invested and he has got some returns in the last 4 5 years, and he wants to switch as per my suggestions. So what I'm suggesting to him is that because your money was already invested and you want to switch, so don't do it via SIP, do it via lump sum. So whatever, say 100 rupees were invested before today till yesterday, you take out 100 and tomorrow you invest whole 100. So that's why I mentioned context. Context is also required whether you are selecting lump sum investing or SIP investing, etc. And the last point is higher initial risk. So this is very important, that you should as investor know, must know and take care, that because you're investing full amount, whatever you have at a particular point of time, whole money will get invested. In case market goes down, whole of the principal will go down as well. So you need to keep that in mind, that you'll be okay with the volatility the market is going to offer. And basically nobody can escape from the market volatility. So you need to be prepared for that, because you are investing all the amount of money you have in lump sum. Now, this is something called SIP, Systematic Investment Plan Investing, where, as the picture depicts, there will be multiple contributions on regular intervals. Um, Say you want to invest 100 rupees, you break them down, say in chunks of 10 rupees each, and you can invest that 100 rupees in say across 10 periods. 10 rupee each period will be invested. Immediate deployment again is there for every SIP amount. So every 10 rupees you invest will be deployed immediately in the markets. Higher admin requirements in terms of that you have to maintain at least 10 rupees in the bank account from which the money will be debited towards AMCs. So that you need to take care. Otherwise, your SIP will lapse, and maybe you will get a notification that you missed this SIP. Nothing more than that. But your money will not be deployed in markets. In this case, as I suggested in earlier videos, there's no need to time the market. That no, your uh, if market is going up, you're buying. If market is going down, you're buying. So there's no as such no need or no kind of great thinking is required that whether market is high, low, or where it's gonna go. No information, no thought process is to be involved. And coupled with that, there will be lower initial risk because you have divided your investment amount in chunks. So only chunks will be at risk in terms of volatility going down. But as such, your whole principal, which you're going to invest, won't be at risk. So risk is lower initially compared to lump sum investing. Now, here, if you pay attention to the picture on the right side, I mentioned that no SIP amount is going up. So this is typically what is called a step up SIP investing, in which you increase the amount going forward. There can be step down SIP, which I think I discussed uh, briefly or alluded to indirectly in my equity savings funds video. So as per your, if you think that you're gonna your income is gonna increase, or your disposable income or your investment amount is gonna increase going further, you can go for a step up SIP investing, in which you increase the amount. Say today you are investing 100, next one you can increase, say, so to 110, and the next, still next month 120, 130, etc. Depends on you, depends on your outlook, your calculation of cash flows which you're going to have going forward. Now I have done the comparison as I mentioned. I mentioned that no, there is lump sum and SIP, how they are different. So as you can see at the bottom left side, somebody invested 1,20,000 as lump sum at the NAV of 10. So he got 12,000 units, and no further amount was invested. So units allocated to him are zero, and he's not worried about the NAV, where it's going to go there, say 10 to 8 to 7 to 8, again 6, and then 9, 10, 11, and then final 12 at which he sold. So units bought remain constant. He is not worried what happened in, say, Feb, March, April, May, June. So units are fixed. It is simplified. At one shot, your money is gone, and you can track that. No, how these many NAVs I got on the first day, and my units are going to be uh, same 12,000. And this is ad hoc investing. This is best suited for the people who are, say, in some business, or who don't have any visibility of when they are going to get disposable income to be invested in stock market. So whenever you get money, you discuss with your investment advisor, or you yourself are tracking the markets and decide the best course of action or best schemes to put your money in. You decide those schemes, the amount, and then you, at one shot, your money is gone, and it has got invested in stock market. Now, coming to SIP, as you can see, some lump sum, say 10,000, got invested every month. So this 120,000 got split into 10,000 slices each to be invested every month. And at different NAVs, say 10, 8, 7, 6, 8, 9, 10, 11, 12, those NAVs were bought, units were bought, and depending on NAV and the amount invested, the units bought are different every month. uh, and finally, after say 1 year or so, investor sold, so he'll be able to sell the units bought at the particular prices in the subsequent months. So as the first point mentioned, NAV units depend on the markets, depend on what the stocks in the portfolio of that mutual fund schemes are doing. It's a continuous process, uh, in the sense that every month you have to invest, and hence it is disciplined that no, every month you have to make sure that your amount gets debited and gets deployed in the market. So you have to maintain that minimum balance in your account somehow if you want to remain invested. It offers flexibility as well. That, remember, I always say to my client that no, your SIP can stop, but your EMIs can't. So you can default on your SIP, in the sense that you can choose not to pay. That no, I want to skip this SIP, or I want to stop SIP. But you can't do it in your EMI. In both the cases, you have to maintain the discipline. But yes, it offers you flexibility in terms that you can stop EMI, you can increase EMI, you can decrease SIP. Sorry, I was saying EMI. Decrease the SIP amount, and also if you want, you can choose the days. So one of my clients is there. He invests uh, every alternate day. Say his SIPs go Monday, Wednesday, and Friday via electronic apps. You can do it now. Earlier, I used to invest via monthly SIPs, but today investors can choose to make contributions on a daily basis. That flexibility is offered by technology today. So SIP in that way is very flexible investing. Now, I want to introduce to you Mr. Peter Lynch. He was a fund manager with Fidelity, I think one of the best, if not the biggest, but one of the most, say, valued and most reputed mutual fund companies. They were in India as well. So he used to manage a Magellan fund for them, and at the age of 46, he retired after managing it for 13 years. Uh, and his fund earned a CAGR of, or CAGR of, almost 30%, which was double of what S&P 500 offered during that time. And he has written some amazing books. When I was starting my investment journey, I read his books, then twice, both of them, one upon Wall Street and Beating the Street. If you can, if you want to read, you're interested in books and investing, I would suggest and even encourage that you buy those books and read them. Very lucidly written, and tons of information is there. Now, coming back to what he said, these screenshots I have taken from his second book called Beating the Street. So if you pay attention to the highlighted part, what he says is, you key to the success of investment clubs, which were run by different at different cities. Say that they used to invest on regular timetable, just like SIPs, which takes the guesswork out whether the market is going up or down. That means if you're investing via SIP, you're not bothered, like in last slide, whether NAV is 10, 9, 6, 8. You are aware that you're buying at every opportunity, every NAV, you're buying some units. So that takes guesswork that no, what is market going to do? What is going to happen in between Iran and Israel? What is going to happen in Ukraine and Russia? What is going to happen in elections in India? What is going to happen in Bangladesh, etc. You're not worried. You know, you're pretty sure that India is going to do good. So you're not worried about the NAVs where market is going up or down. That's where uh, the SIP turns out to be best. And people who invest in stock automatically, that means same amount every month. Uh, that, as I said in the last slide, that requires discipline, but that will bring them the best results. Now, the second highlighted part also says that in case market dips time to time, people who invest extra amount during those dips get substantial rewards. Like he said, that if you had courage to add, say, 10,000 or $1,000 every time the market dropped 10% or more, which it has done in 31 times in the last 52 years, your 83,000 amount, if suppose you had invested, would have gone to, say, 6,003,300,000 dollars. So this keeping cash handy and investing it along with the SIP whenever market goes down uh, reaps a substantial reward at the end. That's what his suggestion. And then, of course, the last line: ignore the scary rhetoric and kept on buying stock. Yes, ignore the noise. Just if you believe in India, keep buying stocks or via mutual fund, or you keep buying stocks directly if you are doing direct investing in stock market. The last slide, my suggestions that you can invest via lump sum or SIP or use both in combinations. Depends on you. Like I said, if you know the market, if you believe in your investment advisor or your mutual fund distributor, you can use both. Discuss with him or decide for yourself. There's no say one way to heaven. That no lump sum is better than SIP or vice versa. Just to keep the other 2 points in mind, that in case you're going for lump sum, be sure that you know the rest, because initially your full capital will be at risk. So if you're switching from one fund to another, that no, I have realized this full potential of a particular fund, or I find some cheaper fund, then go for it via lump sum. If you're going by SIP, make sure your account has enough money on the SIP dates you have chosen, so that you don't default on SIP, or at least the SIP gets money gets debited on those SIP dates. That's all you have to do. Now, my suggestion, which is mentioned in white and subsequently red, is in case, and this advice I keep on giving to my all the clients, that if you have to invest 100 rupees in the market, invest 80 via SIP and keep on accumulating the remaining 20. So, say every say 2 years you get, say, 24 into 20, say 480 cash handy. In case market dips, deploy that money. So that gives you the flavor of both SIP as well as lump sum, but you must know what you're doing. So either you are doing your own research, or you discuss with your investment advisor or mutual fund distributor or whosoever trustworthy you find. uh, Adopt this strategy. That would be my suggestion. And again, in the same way, I would say that in case you are know nothing or know little investor, you don't want to pay attention to the markets, or you don't know, or you don't want to spend time, consult your advisor and distributor, and discuss what is best for you, and they can give you fair advice. Now we have come to the end of this video. As if you want to discuss more, you can ping me on WhatsApp at 808892389. You can call me also on 966 352 0068. If you want to mail me, my mail ID is ashish at kubercap.online. Thank you and happy investing.